Early retirement. It's a dream for many, but how do you actually make it happen? In this video, we are walking through a proven step-by-step strategy to help you achieve financial freedom and retire early. Let's start by understanding what early retirement really means. It's not just about stopping work at 40 or 50. It's about defining the kind of life you want to lead once you stop working. Do you want to travel the world, spend more time on your hobbies, or just relax with your family? Defining your goals clearly is the first step. Set a target age to retire and think about the lifestyle you want. Statistics show that millennials are increasingly interested in financial independence, with 43% planning to retire before 60 according to a global survey. So think about where you want to be and how early you want to get there. The next question is, how much do you need to retire? Here's a simple formula to get started. The 25x rule. Multiply your annual expenses by 25 to estimate how much you need to save. So, if your expenses every year are 10 lakhs, you would need 2.5 crores to retire comfortably. But don't forget to adjust for inflation. With India's inflation rate averaging around 6 to 7% annually, the cost of living will increase, as will healthcare costs and lifestyle expenses as you age. Using online retirement calculators can help you factor in these elements and give you a more accurate estimate of your required retirement corpus. Now that you know how much you need, let's talk about how to get there. The earlier you start, the more you can take advantage of the magic of compounding. For example, if you invest rupees 10,000 a month in a mutual fund that earns an average return of 12% in 20 years, that's over rupees 1 crore thanks to compounding. One of the best ways to build this corpus is through a SIP or systematic investment plan. It allows you to invest regularly in mutual funds, which is key to growing your wealth steadily over time. And for early retirement, diversification is crucial. Spread your investments across equity mutual funds, debt funds, gold funds for a balanced and growth-oriented portfolio.
So, let's understand what an SIP really is. SIP stands for Systematic Investment Plan. With an SIP, you invest a fixed amount at regular intervals, like monthly or quarterly, into a mutual fund of your choice. Usually, an SIP involves investing a fixed amount every month. Think of it as setting a recurring deposit for your investments. Once it's set up, you don't have to worry about timing the market or making those big investment decisions every month. It's automatic. And over time, these small regular investments can grow into a significant corpus. For example, let's say you start a 20,000 rupees SIP in a mutual fund. This mutual fund has given an average return of 14% over a 10-year period. Now, if you're planning to invest for 10 years, you'll be investing 20,000 every month for 10 years. After 10 years, you would have invested a total of 24 lakh rupees in this fund. During that time, every year, your investment could have earned 14% returns on average. The total returns you would have accumulated by 10 years would be 28 lakh rupees. So your total investment value would be 52 lakh rupees.
Another critical factor for early retirement is aggressive savings. Studies show that people who aim for early retirement often save and invest 40 to 50% of their income. The key here is living below your means, downsizing, cutting unnecessary expenses, and focusing on saving and investing as much as possible. It's also important to avoid debt. High interest debts, especially credit cards and personal loans, can derail your plans. Try to pay off all these debts as quickly as possible so you can focus on savings and investing for retirement. Passive income is another major pillar of early retirement. Whether it's from rental properties, mutual fund dividends, or a side business, having additional streams of income can provide financial stability in retirement. For example, rental properties can offer a steady monthly income, while mutual fund dividends give you regular payouts without needing to sell your investments. Start building these passive income streams early, and they can help you achieve financial independence faster. Even with a solid retirement plan, it's important to track your progress and rebalance your portfolio regularly. Markets change, and so will your financial situation. So reviewing your investments at least once every quarter is a must to ensure you're on track. At Stack Wealth, we have curated a mutual fund portfolio that is ideal for retirement, called Ready to Retire. Our expert team monitors and manages this portfolio for you, ensuring you the highest risk-adjusted returns in the long term. As you approach your retirement age, we will also help you shift your investments to increase your portfolio's stability. This will help you easily withdraw from your corpus post-retirement. Finally, don't forget about tax planning. Tax-efficient strategies can help you save more and grow your retirement corpus faster. Mutual funds, especially ELSS or equity-linked savings schemes, not only help in wealth creation, but also provide tax benefits under Section 80C. It is important that you do proper tax planning to ensure you create a strategy that maximizes your savings while minimizing your tax liabilities, especially as you get closer to retirement. One last thing you need to know about mutual fund investing before you get started is the taxation. An important thing to know is that you are only paying taxes when you sell your investments, not when you're holding them. Now, there are two kinds of taxes on your investments. There's short-term capital gains tax and long-term capital gains tax. Short-term capital gain tax or STCG tax applies when you sell your holdings within 1 year from the investment. Long-term capital gains tax or LTCG tax applies to profits from assets held for more than 1 year. Now, the taxation is different for every type of mutual fund. Starting with equity funds, short-term capital gains tax is 20% and long-term capital gains tax is 12.5%. The LTCG exemption limit is rupees 1.25 lakhs. So you will only be taxed on the profits that are more than that amount. Next up, we have debt funds. Now, capital gains from debt funds are taxed according to the investor's income tax slab rate, regardless of the holding period. Finally, we have hybrid funds. Now, the taxation of hybrid funds depends on the fund's asset allocation. If the asset allocation of equity is greater than or equal to 65%, it is treated as an equity fund. If the asset allocation is less than 65% of equity, then it is treated as a debt fund. So now you know what are mutual funds. So there you have it. The 6 key steps to early retirement. Setting your goals, calculating your corpus, investing early, maximizing savings, building passive incomes, and monitoring your portfolio. Early retirement is achievable if you plan smart and stay consistent. And if you need help getting started, Stack Wealth's Ready to Retire mutual fund portfolio is designed to make early retirement a reality. Stack Wealth is a new age investment management company that helps you take your wealth to new heights. Our team consists of experts with 25 plus years of experience managing investments for more than 1 lakh investors. Our team of experts help you curate a personalized mutual fund portfolio based on your goals and risk tolerance. They help you decide your asset allocation. They also help you identify high performing sectors to help you generate additional returns. And finally, we help you manage and monitor your investments in real time. First, download the Stack Wealth app from the Play Store or App Store and complete your sign up by entering your mobile number and email ID. Now you can explore the app, get your personalized mutual fund portfolio, or browse our various investment opportunities. To start investing, you have to complete your KYC. Once your KYC is completed, you can start investing in your personalized mutual fund portfolio or explore our expert curated investment opportunities. If you're not sure where to begin, your dedicated wealth manager will help you. Now you can start an SIP or make a one-time investment. Remember, you can always pause your SIP anytime and edit the SIP amount if you want to increase or decrease it. Finally, you can sit back, relax, because our wealth team will rebalance your portfolio based on shifting market conditions, identify and recommend new investment opportunities, give you monthly portfolio reports so you know exactly how your portfolio is performing. If you found this video helpful, don't forget to hit that like button, subscribe to our channel, and tap the bell icon to stay notified, because we are making finance and investing as simple as possible for everyone. Thank you for watching and goodbye.